Hi, welcome to Market in a Minute. This is where we analyze the markets, looking for opportunities, but most importantly, protecting our downside when we need to. So, reviewing a little bit about what happened last week, we had Jackson Hole on Friday, and it was as expected, as what we expected, I should say, a little bit hawkish for the overall markets, but we think the market's getting the interest rate picture correct this time. So there's about a 20% probability of a rate increase in September. That's probably about right. And then a 50% probability of a rate increase in November. And then looking out to next year, and then next year, there's over 50% probability that interest rates will be down roughly 1%. We think that's pretty much in the ballpark of what will happen. Now also last week, we had NVIDIA report on Wednesday. They had a great quarter, better than what was printed in terms of the expectations, but it didn't beat the whisper number. So it came out over 13 billion in revenue. The expectations were roughly 11 billion in revenue, and our expectations of what the whisper number was is about 15 billion. And so the stock hasn't really done a whole lot since that point in time. Granted, it's had a big run. It's probably someplace to put some money in at some point in time, but you can see the stock's pretty fully valued where it is currently on these expectations. So we want to walk through what's going on in the markets a little bit as we see that the most important thing with the markets is the 10-year Treasury, in our opinion, right now. And then it will shift a little bit to earnings as we go into the fourth quarter earnings reports. But based on the 10-year Treasury at 4.22, now it's come back a little bit. It was over 4.3%, so it's down a little bit in terms of yield. But it currently makes the S&P 500 about 9% overvalued. And as we go through the charts, our system of technical analysis, identifying the opportunities, we see that the S&P 500, as we discussed last week, it broke to 20-day, it broke to 50-day, so that puts us on pause with that index a little bit, right? So we think the next stop on the S&P 500 likely will be sometime in September around that 4,300 level. It's quite a distance away from the 200-day moving average, which makes us hesitate in terms of actually putting that in the portfolio if it would go back above the 50 and 20-day moving average. So there's some indexes that look a little more interesting. And the first one is the equal weight S&P 500. You can see that it's broken the 20 to 50, broke the 100-day, and tested the 200-day moving average. So we can invest in the equal weight and use the 200-day moving average, just below the 200-day moving average, as a stop point. Same way with the Russell 2000. It's broken the 20, 50, down to the 100 and 200-day moving averages. Again, it's not far from the 200-day moving average. It makes us feel good about an easy exit. We need to do so. Now, EFA, so this is the international stocks, it's broken all three and broke through the 200-day, back above the 200-day, which gives us a nice buy signal. So we like EFA, Russell 2000, and the equal weight S&P 500. Now just keep in mind, if the expectations move to, okay, we're not going to have a recession, it becomes more clear, I should say, not going to have a recession until the second half of 2024, the market's going to gravitate to these three different indexes because people feel better about the economy, and these things are oversold, and there's some attractive valuations of stocks in these three indices. So on Thursday, we get the inflation report, or a inflation report. This is a big report for the Fed. This is the PCE, which is what they like to look at mostly. And you can see the trend here. It's not as dramatic as the CPI in terms of it's a big movement to the upside because it takes out food and energy. But you can see that it's been roughly 4 to 5%. And last month it was 4.1. The current expectation on this inflation barometer is 4.2. We wouldn't be terribly surprised if it came in below 4. And we think if it does, then the bond market is probably going to like that, and the 10-year Treasury yield to come down a little bit maybe it'll get the stock market to go up as we go into September. Looking at the employment report on Friday, so what is most important about the employment report is not how many jobs were added, but the expectation is 175,000 jobs, but it's the average hourly wages. So last report was 4.4%. Above 4, we think the Fed stays tight. They continue that policy. Much below 4, we think they start to ease back a little bit and become more comfortable about the direction of inflation, and therefore interest rates could actually come down, as we discussed. Rather than having a recession last part of next year, we might be able to actually have a soft landing. So that'd be great for those 3 indexes we just talked about. But at this point in time, we don't think that's likely to happen. We think we're going to go into a recession second half of next year. But the wages are the most important factor in these reports and any inflation report going forward. That's what the Fed's focused on. So to summarize all this, the technicals of the market are weakening. Some of the sub-indexes, as we described, look pretty interesting for trading potential. So there might be good trades in the fourth quarter. And then we have some interesting stocks that we think you can put in a portfolio and that are completely washed out in some cases. So Viking Therapeutics, this is not washed out, but it's down quite a bit from its recent high. I think most people thought they would be acquired. They have 2 really interesting drugs that make this company worth a lot of money to a large pharmaceutical company. Their drugs look really great. So we think that there's maybe a double or a triple in this stock on a takeover. U.S. Steel was in play, letter X. So the current bid for this company is $35 a share. It's likely to go higher in our opinion because U.S. Steel thinks they're worth more. We'll see what happens. So we think it's worth putting a little bit of money into it and maybe move from $30 to $40 or $45 a share. Disney is really cheap now. You know, they stubbed their toe. They stubbed both toes. So this stock is trading at the valuation it did in the bottom of the pandemic in 2020. So it's trading roughly 10 times market cap to EBITDA. So that's really cheap for that stock. There's a lot of valuable assets in that company, easily split up, and you could get a double in that stock price. So if you're Apple or Amazon wanting to be in the entertainment business, Disney is a prime takeover target, or maybe parts of Disney, so they could sell it off in parts instead. Macy's, Macy's is in a tough position. The guy that came in there is turning that thing around. Actually, I think he's doing a pretty good job. Their real estate is worth probably $24, $25 a share. This stock's trading at 12. Really cheap stock. I think it's worth a little bit of play in a portfolio to get a double or triple out of this one as well on a potential takeout. Oh, by the way, football season starts on Thursday. Here's my predictions. Ohio State beats Michigan. Alabama beats Georgia. Ohio State, Alabama in the finals. Take care.